Financial risk is a very key area of the syllabus. It actually accounts for 35% of your syllabus weighting. So it's an area you've got to be comfortable with. Now, despite what you may have heard, that doesn't mean this paper is full of complex derivatives or maths. It's actually, financial risk is to do with something that is much more straightforward and much more in line with the rest of the paper. It's to do with your risks relating to financial matters. In other words, your what could go wrong. So what could go wrong relating to financial issues, foreign exchange, financing and so forth. And then we look at what are the controls over those risks. So how can you try and minimize the chance of the risks causing damage? How can you make sure that what should be happening is happening? That's what this is about. So the first thing we're going to do in this chapter is look at what we mean in this paper by financial risks and what specifically could go wrong. We'll then look at some of the different ways of assessing or measuring financial risk, and there are a number of techniques we're going to look at. The one I'll highlight at this stage, because it's the most examinable, is value at risk. We'll look at what it means, what it can show you, and also how to calculate it. Having looked a little bit about how to measure financial risk, we'll start to think about the controls over financial risk. And the controls over financial risk, like the controls over anything else, can take the form of HR controls, so you can do things to do with people, get people in with expertise in managing financial risk. You can have procedures, processes in place to reduce the risk of something going wrong, or there are various measures or various output controls you can put in place as well. So we'll see how that framework applies here, as it does in all other areas of risk. What we'll then start to look at are derivatives, because derivatives are one of the ways in which organizations can manage financial risk. And we'll work through some fairly straightforward numbers to illustrate what we mean by different types of derivatives. What we mean by a forward contract, which is basically an agreement to trade in the future. That's all it is. You're making a deal that's going to take place in the future. A future is actually very similar, except that the contract that you make is tradable. You can actually buy and sell it to other people, and there are a number of implications of that. We'll look at options, which is where you can choose whether to trade or not. And we'll touch on swaps and look at those in a little bit more detail when we consider interest rate risk. What we'll also then deal with briefly is the issue of how organizations disclose their financial risk and what are some of the accounting issues around that. Now, we're not going to go into detail on this, but it is important from a risk management point of view to be aware of some of the main accounting principles and what their implications are for organizations. Now, having said that financial risk is 35% of the syllabus, it's obviously important to define what, in that case, we mean by financial risk, because the term is used in all kinds of ways in various contexts. What the examiners mean by financial risk in this paper is what is sometimes called market risk. So you are talking about the risks that relate to the changes in market prices, particularly financial market prices. And there are three types of markets that are focused on here that are listed out here in your notes. They may be changes in interest rates, changes in exchange rates, or changes in commodity prices. That's what we're dealing with in this section of the syllabus. So having looked at what financial risk is, our next question is, how can it be assessed? In other words, how can you measure your level of financial risk, and how do you know it's there? Well, there are three techniques that you will have come across earlier on in your studies that are assumed knowledge for this paper as well. You're not going to see numerical questions to the same level of detail that you did earlier on in your studies, but you do need to be aware of them and how to use them to measure risk. Firstly, we have sensitivity analysis. And you'll remember that what sensitivity analysis does is that it isolates certain variables. So if we have, for example, a project appraisal or a forecast, we can work out how sensitive the value of the project or the forecast is to a change in one variable. For example, we might look at how sensitive it is to a change in revenues. If quite a small change in revenues means that we move into a loss-making position or the project is not viable, then that may mean that we have a high level of risk. Secondly, there is regression. And what you can do with regression is you can build up, as we see here, a sort of equation that measures your cash flows and looks at the impact on those cash flows of various external factors. In this equation, the alpha represents the underlying performance of the business. And then we are modelling the impact on cash flows of changes in certain other factors. In this example, those three factors are interest rates, foreign exchange rates, and commodity prices. Now, this is going to be subjective, but what it may do is it may, for example, highlight that you are very vulnerable to changes in commodity prices, and quite a small change in prices may have quite a large impact on your cash flows. In that case, it suggests that you have a high level of risk. The third of these techniques is simulation. And simulation means that you are calculating a number of possible outcomes relating to a certain project or a certain venture or perhaps the next year's forecasts. Once you've done that, you can work out what your mean or average outcome is, and then you can work out the standard deviation, or to use another term for standard deviation, the variability of those outcomes. The wider the variability, the higher the standard deviation, the greater the risk. A third way of assessing financial risk is to use scenario planning, and this overlaps with a number of other papers in your CIMA studies. Scenario planning is essentially what-if analysis, thinking about future possible situations such as perhaps a change in commodity prices or interest rates, and then working through the consequences for your organisation. Having done that, you can make a decision as to whether this is a serious issue for you or not, and whether you need contingency plans to deal with this event if it takes place. Now, the fourth way of assessing financial risk is new to this paper and is highly examinable, and it's called value at risk. Now, to explain what value at risk is about, it's probably easiest to refer back to our normal distribution curve. Now, you'll remember the normal distribution. Normal distribution is one where the mean is the same as the median and the mode, that is your average, and it's symmetrical, so it's the same shape and same distance either side. And in the normal distribution, the further away you get from the mean, the lower the population. In other words, most of the population is clustered fairly close to the mean. What value at risk does is applies the idea of normal distribution to some sort of financial risk. Let's say investment returns. This is a fairly typical use, both in the exam and in the real world, of value at risk. Now, if your returns are normally distributed, and if you're going to use value at risk, you have to assume that they are, then there is an equal chance that you will make a profit. There's a 50% chance you will make a profit, and there is a 50% chance you will make a loss. Now, if we're going to make a profit, we don't mind how big a profit we make. The more the better. So that is not a risk. That is not something we're particularly worried about. We're not worried about that 50% chance we make a profit. However, we are worried about that 50% chance we make a loss. And in particular, we're worried about the extreme end here. We're worried about the highest levels of loss. Now, value at risk allows us to put a value that relates to the probabilities of certain loss. And in an example, which is fairly common, that says we assess value at risk with 95% certainty, what that means is we want to know the point X, the level represented by a 45% probability of loss. In other words, there is a 5% probability that our loss will be greater than X. There is a 45% probability that our loss will be lower than X, and there is a 50% probability that we're going to make a profit. So in this example, X is our value at risk. Now obviously this will only hold good for a certain time period, because depending on how big the time period is, the variability is also going to be affected. Over a long time period, your variability is much greater, and this normal distribution curve is going to be much wider. So in order to calculate value at risk, you need to know what certainty level you're dealing with, and you also need to know what time period you're dealing with. Okay, 1 day is typical. So let's go back and look at the definition of value at risk. It is the maximum loss possible due to normal market movements, in other words with normal distribution, for a given period of time for a given level of probability. It is quite commonly used to value share portfolios, can also be used to look at foreign exchange transactions. We have here the formula that allows you to calculate value at risk. It is the mean plus the confidence internal value times the standard deviation. Sometimes you might need to calculate value at risk numbers for periods other than 1 day, in which case what you need to be able to do is convert the standard deviation number from 1 day to another time period, and vice versa. Once you have your correct standard deviation number, you work out your value at risk as normal by applying the z-score. The formula that you need to know to be able to do this is that the daily standard deviation is equivalent to the standard deviation for another time period divided by the square root of the number of days covered. Now just to illustrate this so you can see exactly what it means, let's say you're given a weekly standard deviation of $100,000 and there are 5 working days in a week. To do the conversion, you take your $100,000 and you would divide it by the square root of 5, which happens to be 2.236. 100,000 divided by 2.236 gives you $44,723. That is your daily standard deviation. And then you can use that in your value at risk calculation. Of course, the same formula works the other way around, and let's say you've been given your daily standard deviation of $44,723, and you need to work out the weekly standard deviation, so you can calculate a weekly value at risk. To do that, you would take your $44,723 and you would multiply it by the square root of 5. As we know, the square root of 5 is 2.236, so that will give you a weekly standard deviation of $100,000, and again, you'll use that in your value at risk calculation. So it's just a small formula, worth remembering, maybe tested for a couple of marks or so. So we've got a mini scenario here of a company that's going to receive €20 million in 1 month time and does face the prospect of a gain or loss depending what's happening with the exchange rates. We're told that the mean in this example is 0. Now again, that is a very, very typical situation. On average, you think that there is an equal chance of making a gain or a loss, and over time they're going to balance out to 0. You're given here the standard deviation, and if you're asked to calculate value at risk, you're very likely to be just given the standard deviation, and that is £50,000. That's how we can measure the amount of risk. We're then asked to calculate the value at risk based firstly on 95% accuracy. So we're happy taking a 5% risk. Now going back to our table, that is picking up the situation we described here. There's a 5% risk of making a very high loss. And what is point X? What is the point on the line where we are 95% likely to either make a profit or a loss lower than that amount. We are 5% likely to make a loss higher than that amount. Well, we can work that out using our formula. And our formula is the confidence internal value times a standard deviation. Well, we know what the standard deviation is. In this example, it's £50,000. But what's the confidence internal value? Well, it's the number of standard deviations away from the mean. So, looking at our example, what we want to know is how far away is x from the mean? How many standard deviations? Or to use the abbreviation, use the Greek sigma. How many standard deviations are we away from the mean? Now, in order to do this, you're going to have to look up your standard deviation table, which you'll find at the back of your notes. And we'll just recap quickly how to locate the standard deviation value. Remember, what we're looking for here is the number of standard deviations equivalent to 45%, because we're only looking at the loss side of our diagram. Now, the way that number is expressed in the table is going to be 0.45. So we're looking for 0.45 probability, and then we're going to translate it into the number of standard deviations. Well, looking down the table, can we see 0.45? No, but we can get close. What we have is 0.4495 and 0.4505. So 0.45 is going to be directly in between the two. So let's read off our table how many standard deviations that's equivalent to. Well, reading along to the left, we can see that it's 1.6 standard deviations, and then for the next decimal we can read off the top of the table, which is somewhere between 0.04 and 0.05. So we can say that the number of standard deviations is halfway between 1.64 and 1.65. So to be completely accurate, we are looking at a point which is 1.645 standard deviations away from the mean. Now let's plug that back into our calculation, and if we know the number of standard deviations is 1.645, we can say that the value at risk with 95% certainty is 1.645 times 50,000 plus the mean, which we know in this case is 0. We're told the mean is 0. We think that gains and losses are going to cancel each other out. So our value at risk is £82,250. Or to put it another way, if we look back at our graph, this point x is £82,250. There is a 5% likelihood we're going to make a loss higher than £82,250, 45% chance we make a loss lower, and a 50% chance we make a profit. Now, it may seem daunting. It is actually a reasonably straightforward calculation, which is why, if you look at the lecture example, doing these two calculations actually only carries 6 marks. But just to give you a bit more practice in this, have a go yourself at doing the calculation B. So it's the same calculation, but now we want to be 99% accurate. We want to calculate value at risk with 99% certainty. So press pause and see how you go with that calculation. Okay, so let's look at the calculation with 99% certainty. Well, the concept is exactly the same. If we look back at our diagram, all we're saying here is that now we need to find out our new value at risk in the assumption that there isn't a 5% but a 1% chance of making a loss greater than this amount, and there isn't a 45% chance but a 49% chance of making a loss lower than that amount, and of course still a 50% chance of making a profit. So what we're going to need to do is go back to our standard deviation table and see if we can find 49% in our table, or as it will be expressed here, 0.49. So if we look down our table, we can't see exactly 0.49, but we can see 0.4901, which is extremely close, and it'll do for our purposes. Reading off the table, we can see that is 2.3 standard deviations, and then reading to the top of the table, we've got 0.03. So we can say that this 0.4901 is 2.33 standard deviations away from the mean. So let's plug that back into our calculation. Now, our calculation, remember, value at risk is the number of standard deviations, which in this case is 2.33, times the value of the standard deviation, which is £50,000, plus our mean, which is 0. So with 99% certainty, our value at risk is £116,500. In other words, looking back at our diagram, there is a 1% chance we will make a loss greater than £116,500, 49% chance we'll make a loss lower, and a 50% chance we'll make a profit. Now, just so you're aware, this is a very, very widely used tool. It comes out with a nice simple number, it's fairly easy to understand, and it's fairly easy to track over time. But it does have a number of flaws, and one of the most important ones that recent years has exposed a bit is that it assumes investment returns are normally distributed, and a number of people would challenge that assumption. But nevertheless, it's still a widely used tool. You do need to know how to calculate it. You also need to explain what the numbers mean and how it may be used. So what we've done is set up some of the different types of financial risk and looked at how they can be measured and how they can be assessed. It's now time to start thinking about controls. What can organisations do about these financial risks? Now, before getting into any of the detail in the calculations, it's very important to appreciate that you control financial risk in the same sort of ways as you control any other risk. In other words, you can have input controls. You can employ an expert. You can have people controls. Make sure the right people are dealing with it. And what that means in terms of financial risk is that you hire a treasurer or a treasury function. You make sure you have a really, really good treasury function, and they will look after financial risk for you. That is one possible approach. We'll go into slightly more detail in a moment. Secondly, you could have process controls. You could have some sort of procedures. And we will spend quite a bit of time looking at one particular type of procedure you can carry out, which is hedging. We'll go into what a hedge is, but you could say, have a procedure that says, if we are exposed over a certain level, we will put some sort of hedge in place. And finally, you can have output controls over financial risk. In other words, you can have some sort of measurement. And we've just looked at an example of this. You might measure value at risk, monitor it daily, and if it goes over a certain level, you do something about it. That is a measurement control. So hopefully that helps to illustrate the range of controls you can use here. Now, just to dwell slightly on the Treasury function, it's important that you appreciate the Treasury function are specialists in management of financial risk. We've got a list, reasonably straightforward list of the sorts of things that the Treasury function will do. Now, in your F3 studies, you will go into a lot more detail on the Treasury function and how they operate. So I'll leave it to be dealt with in that paper, but please do bear in mind that this is examinable in P3 because it is part of the controls organisations will typically put in place. Now, the other term we mentioned above was hedging. And this may form part of your risk management strategy. Now, as with any other type of risk, you need to assess it, decide whether it's acceptable or unacceptable. It may be that your risk is so high that the organisation is not prepared to take it, and therefore you're going to abandon it. However, one of the other things you can do about a risk that is not considered quite so serious is to use a hedge. And we've got the CIMA definition here of what a hedge is. It's a certain type of transaction that reduces risk. But I'll just make one point that is relevant to exam solutions. Hedge is a very, very general term. It covers all kinds of transactions. So if you are asked to suggest ways in which an organization might control a risk, please don't write they should hedge. Right? That is far too general. It's far too vague. You need to be much more specific about what sort of hedge they would do and how they would put it in place. Okay, so make sure you are really going into the detail, because all kinds of things can be referred to as a hedge. In this next section, we're going to start looking at derivatives, which are a set of tools that organizations use to manage financial risk. You've got the CIMA definition here, and the easy way to remember what a derivative is that it derives its value from something else, hence the name. So a derivative is a type of financial instrument, derives its value from something else, such as the price of a share or a currency. Now, as we've all seen in recent years, derivatives can get quite complex, but in this paper, the way they're examined is reasonably straightforward. There are 4 types of derivatives that are examinable in this paper, and we're going to have simple examples to introduce them. The first type we're going to look at is referred to as a forward contract. And this is simply, the definition says, an agreement to deal at a future date. It is an agreement to deal at a specific date and at a specific price. Now, to illustrate how this might work, we've got a lecture example here involving cocoa beans. Have a read through the example and the requirement, and then press play when you're ready to go through the numbers. So the example we have here of a forward contract is an agreement to buy a ton of cocoa beans at $2,100. So what's the outcome going to be if the spot price actually turns out to be $2,200? Well, we would have paid $2,200 if we had had to buy on the spot market. However, we did pay $2,100 because of our forward contract. That means we are $100 better off because of our forward than if we'd just relied on the spot market. What about the seller? Well, the seller would have sold for $2,200, and instead of that, because of the forward contract, they did sell at $2,100. So for the seller, they're actually able to charge a lower price than they would have done if they just sold in the spot market. They are actually worse off by $100. Okay. Now, just to introduce you to the terminology here, we have a long position in cocoa beans. And if we have a long position in something, we will make money if the price goes up. Our seller has a short position. They will lose money if the price goes up. However, the reverse is also going to be true, as we'll see in our next illustration. If the price goes down and we have a long position, we lose money. If the price goes down and we have a short position, we make money. So what happens then if the spot rate actually turns out to be $1,800? Well, we would have paid for our cocoa beans, if we just relied on the spot market, $1,800. However, we did pay $2,100. So in this situation, we are actually worse off by $300. And we have lost money because the spot price has gone down. We're paying more for our cocoa beans than we needed to. From the point of view of the seller, well, we would have sold for $1,800 in the spot market. However, we did sell at $2,100 because we had our forward contract in place. That means we are actually better off by $300. Okay, so that's the consequences of different movements in the market price if we have a forward contract in place. Now, just as a supplementary point to this, what's going to happen if our customer withdraws their order? Remember, the reason we entered into this forward contract is because we are fulfilling a customer order on the 28th of February, and therefore we wanted to make sure we knew what price we were going to pay. Well, if our customer withdraws their order, the way the forward contract is structured, we will have to go through with the contract. It doesn't matter what happens with our customer. We've made a deal with the seller. We are going to have to buy those cocoa beans at $2,100. If we haven't got a customer to sell them to, then we can either retain them and perhaps hope that the price goes up. Although, given this is perishable commodity, the amount of time we can retain them for may be limited, or we simply sell them in the market. Depending what has happened in the market, it is possible we might make or lose money on that transaction. But what we're doing here is we are taking a risk. This is a what could go wrong. A customer could withdraw their order. We may find ourselves with a load of cocoa beans, and we are at the risk then that the market price has fallen and we have to sell them at a lower price. The second type of derivative we're going to introduce is called a future. Now, a future has some similarities to a forward. Like a forward, it is an agreement to buy or sell something at a fixed price and a specified date. But there is a difference to forwards which has a lot of implications. A future is traded. It is tradable on an exchange. It can be bought and sold. A forward is not tradable. When I made a deal with the seller to buy those cocoa beans, that deal is between me and the seller. I can't sell on that contract to someone else. With a future, I can. Now, because it's tradable, there's a very, very important implication of this. It must be standardized. If we're going to buy and sell these things, everyone has to know what they are buying and selling, so it needs to be standard contracts. And the third introductory point about futures is that if they're used for risk management, which they will be, most times you come across them in this paper, then the futures transaction is in addition to the underlying transaction. And we'll illustrate that with some numbers in the next lecture example. So have a read through the next lecture example where we are going to reduce our risk involved in buying and selling cocoa beans by the use of futures. And press play when you're ready to go through the numbers. Okay, so this lecture example starts the same way as the previous one. We need to buy a ton of cocoa beans to fulfill a customer order. However, one of the differences to the previous lecture example is that we're not entirely sure when that order is going to be placed. It's going to be placed at some point during March. Now, this might be a clue that perhaps futures are a better way of managing this risk than forwards, because futures, with their tradability, allow us to be more flexible. We're concerned about the price going up. The price going up here is the what could go wrong, remember. That is our risk. That is the risk that we're looking to manage. Now, there's a market in cocoa futures, and we're buying a 3-month contract for 1 ton at $2,100. That means that on 31st of March, when the contract expires at the end of the 3 months, we are committed to buying the 1 ton at $2,100. However, what often happens with futures, and what we plan to do, is to close our position, to use the terminology, and the way you close your position is by having an equal and opposite transaction to the one that you took out at the start. So, on top of our having bought 1 ton of cocoa futures, we are going to sell a contract for 1 ton of cocoa futures. And in a moment we'll see how that works with the numbers. We're going to do that, it turns out, on the 10th of March when our customer places their order. So let's work through the numbers and see what happens under 2 different scenarios with a spot price at $2,200 and $1,800. Under the first scenario, we have bought our futures contract, remember, at a price of, going back to the scenario, a price of $2,100. And what we're going to do when our customer places their order is we are going to sell a futures contract at the price that is prevailing at the 10th of March when we're selling the contract, and the price in this first scenario is $2,200. So we are going to sell the contract for $2,200. Now what we've done is we have bought something for a lower price than we sold it. And futures are like anything else. They're like commodities or food. If you can buy it for less than you sell it, you have made a profit. So we have made a profit on our futures transaction of $100. And what's going to happen is that the exchange will simply pay us that $100. Notice, by the way, that we haven't had to actually take delivery of the cocoa beans. All we've done is engage in a couple of transactions, we've made some money on it, and we're going to get the cash. So we've made a profit of $100. Now remember, we still have our customer order. So our customer places their order, and to fulfill that order, we need to buy the cocoa beans on the market. And remember what their price is. The price on the market is $2,200. So we buy the cocoa beans on the market for $2,200. However, we have made a profit of $100. So the net cost of our cocoa beans, the $2,200 minus $100, is actually $2,100. That is how much the cocoa beans have cost us when we take into account the futures transaction. Let's see what happens if we have a different outcome. Let's see what happens if the price turns out to be $1,800. Well, in that case, again, we are going to have bought our futures contract the same price, $2,100. And then when our customer places our order, we are going to sell our futures contract for the number that we're given, $1,800. So we sell our contract for $1,800. That is the prevailing market price in the futures market at the time we're closing it out, at the time we're selling a contract. Now what's happened is that we have bought our contract for a higher price than we've sold it. And if you buy something for a higher price than you can sell it for, you haven't made a profit, you've made a loss. So we have made a loss on our futures transaction of $300. And we would have to pay that money over to the exchange. Again, we haven't actually physically traded in cocoa beans, we've done a couple of financial transactions, we've lost money on it, we're going to have to pay that money over. What we're then going to do is we are going to buy our cocoa beans on the spot market we are going to buy them for the market price, which is $1,800. So, what is the net cost of our cocoa beans now? Well, we paid $1,800 for the cocoa beans, and we made a loss of $300 on our futures transaction. So our net cost is $2,100. Now I'm sure you've noticed what's happening here. What has happened is that in each case, whatever the market price is, we have ended up paying the same amount, the same net cost for our cocoa beans, $2,100. And this is how futures work, and this is how futures can manage risk. On the assumption that the spot price and the futures price are the same, and in general they will be, there may be some exceptions to this, but in general they will be, but if they are the same, then what you are doing is you are guaranteeing the price of $2,100. You're guaranteeing that whatever happens to the price of cocoa beans, those cocoa beans will cost you $2,100 whenever you close out your contract. And then the other point to mention about futures is the point that we touched on previously, that there are two contracts going on here. There is a futures contract, and then entirely separately to that, there is what is usually called the underlying contract. So you are buying your cocoa beans, you're physically buying your cocoa beans, but on top of that you are also undertaking a contract in financial futures. And the reason you're undertaking that futures contract is so that you can manage risk. In this case, remember, the risk is that prices go up and makes your cocoa beans more expensive. You are managing that risk by using financial futures and ensuring that you're going to pay a price of $2,100 whatever happens. That is the purpose of the futures transaction. The next type of derivative we're going to look at is an option. And the key difference between an option and the type of derivatives we've seen already is that an option holder can choose whether to go through with the transaction or not. So you agree to buy or sell something at a fixed price at a fixed point in the future, but then you decide whether you want to actually exercise the option and either buy or sell. So the very important implication of that is that you reduce or possibly even eliminate your downside risk, but you benefit from the upside. Now that is not true of forwards or futures. Forwards or futures reduce or eliminate risk, but there is no upside. You will miss out on the upside. An option allows you to benefit from the upside. Now these may be exchange traded, they may be traded in some sort of organized way, or it's possible that they're agreed just between two parties in a private deal, and those that are agreed privately are referred to over-the-counter or OTC options. Again, we're going to illustrate this with a lecture example, so have a read through the lecture example, press play when you're ready to go through it. So to pick out the main points from the lecture example, we have a spot price of $2,000 per tonne, and again we're going to buy a tonne of cocoa beans to fulfill a customer order. We're concerned about the price going up. Our risk is that the price goes up and makes our beans more expensive. However, we think there's a chance they'll fall. We don't want to miss out. In other words, we want to keep any upside if we can. So what we're going to do is take out an option. And the type of option we need here is referred to as a call option. A call option is an option to buy something. Incidentally, a put option is the opposite, is an option to sell something at a fixed price, at a fixed date. So we're going to take out a call option to buy a ton of cocoa beans for $2,100. What that will do is set the maximum price that we will pay for our cocoa beans. If the market price goes over $2,100, we're still only going to pay $2,100. However, if the market price is lower, we can forget about our option and just go with the market price. In that respect, options are a little bit like insurance. They cover us if something goes wrong, and if things go well, we don't need it. And just like an insurance policy, you get charged a premium for an option. In this case, the seller's going to charge us a premium of $70. So what happens if the outcome is $2,200 market price? What's the outcome for us and for the seller? Well, for you, if the market price is $2,200, we are going to exercise our option, because we'd much rather pay $2,100 for our cocoa beans rather than $2,200, which is the market price. So we are actually going to be $100 better off. However, we have had to pay our premium. We've had to pay $70 in order to get our option. So we're allowing for our $70 premium. Our net gain is actually $30, our net outcome. What's the outcome for the seller? Well, the outcome for the seller is opposite. The seller is going to have to sell at $2,100, and therefore, compared to the market, is actually $100 worse off, because they're selling to us at $2,100. That is $100 lower than the market price. However, they have received the premium, $70. So in total, they are $30 worse off than if they had done nothing. So that's their overall outcome. What happens if the market price actually turns out to be $1,800? Well, in this situation, we are going to let the option lapse. We are not going to exercise the option, because we would rather pay $1,800 in the market for our cocoa beans rather than use our option and pay $2,100. So we will simply pay $1,800. We will benefit from the price reduction that has taken place. However, we still have to pay our premium. Of $70. That is a sunk cost. And obviously the amount of the premium has no bearing whatsoever on whether we choose to exercise our option or not. It's a past sunk cost. What's the outcome for the seller? Well, the seller simply receives $70 premium, and they don't actually have to carry out any other transactions at all. So as far as the seller's concerned, they've just made $70. That is pure revenue. So what's happening with the option? Well, the overall effect of what's going on here is that the risk has been transferred from the buyer of the option to the seller of the option. If you think about the risk profile of the two parties here, you, in this transaction, is not really taking a risk. You are going to pay a maximum of $2,100 for your cocoa beans, And then the very worst that can happen if the price really goes very, very high is that you pay your $2,100 and you've had to pay your $70 premium as well. But that's the absolute worst that can happen. Apart from that, you have eliminated your risk. For the seller, on the other hand, the seller is actually taking quite a high risk because they don't know what the price is going to turn out to be. We've seen that if the price goes to $2,200, they're going to be $30 worse off in total. But what if the price goes to $2,500, goes to $3,000, goes to $4,000, $5,000, $6,000? These things can happen, they're perfectly possible. In that case, the exposure of the seller of the option is unlimited. In theory, there is no maximum price of cocoa beans, so there is no maximum to the risk that the seller is taking. And this is why selling or writing options is something that only the very large organizations with a high risk appetite are going to undertake. Now, I mentioned previously that options can be traded. They can be tradable. And for something to be traded, what that means is that you have to have an agreed price for those options. In other words, you've got to have a way of valuing them. Now, until the 1970s, this wasn't possible, because there was no agreed basis for valuing options. But in the 1970s, something called the Black-Scholes pricing model was developed. Now, the Black-Scholes pricing model is a very clever piece of maths that allows you to calculate the price for an option given 5 variables. Fortunately, for these exam purposes, you don't need to be familiar with the maths, but you do need to understand the 5 variables and how they operate. So have a read through those variables, and then we'll have an illustration. To illustrate those variables, let's take a simple example. Let's say I have some share options. I'm part of a share option scheme, and I have an option to buy shares, let's say at £3.90. Now that price, that £3.90, in the terminology of options, is referred to as the strike price. Okay, so my strike price is £3.90. And let's say I have an option to buy shares at £3.90 now. Okay, so we'll bring in time later, but for the moment, let's say there's no time delay. We have an option to buy now. How much is that option worth to me? Well, it depends what the market or current price of those shares are. If the current price, let's say, of those shares is £4, then the option is worth 10p. The option is going to be worth 10p because I can buy the shares at £3.90, I can then sell them in the market at £4 and make 10p, or I can just hold on to those shares and they've cost me 10p less than they would have been. That 10p is referred to as the intrinsic value. The intrinsic value of this particular option is 10p, the difference between the strike price and the current price. So 2 of the 5 variables involved in the Black-Scholes pricing model are the strike price and the current price, and hopefully you can see why. If my option was exercisable now, those would actually be the only 2 variables involved in pricing. But most options are exercisable at some point a bit further into the future. And that means we need to bring in some issues of time. So let's say I have an option to buy shares still at £3.90. The current price is £3.50. But the option isn't exercisable now, the option is exercisable in 6 months. How much is that option worth? Well, what's the intrinsic value? The intrinsic value is actually 0. If that option was exercisable now, it would not be worth anything to me, because there's no reason why I'd want to exercise my option to buy at £3.90 when I can buy these shares in the market at £3.50. However, because the option is exercisable in 6 months' time, it's likely to have some value, because there is always a possibility that by the time the option comes to be exercised in 6 months, this price of £3.50 may be above £3.90. What we need to do is work out a number for this maybe. We need to work out how likely it is that the price may be above £3.90 in 6 months' time. How can we do that? Well, we need to know two things in order to calculate that. Firstly, we need to know the time. How long is it before the option becomes exercisable? The longer that time period is, the more likely it is that the price may move above £3.90. We're giving the price longer to move. So in this example, it's 6 months. So that 6 months tells us something about how likely it is that the price will go above £3.90. But it only tells us something. We need to know something else. We need to know the variability. If the price of this share has been £3.50 for the last 10 years, it's not particularly likely that in 6 months' time it's going to be above £3.90. So if its price graph is just a straight line at £3.50, that means that there's very little likelihood it's going to go above £3.90, and we're not really going to be prepared to pay very much for this option at all, if anything. However, it's quite possible that the history of this share price has been all over the place. Happens to be £3.50 now, but it's quite regularly been above £3.90. In which case, there's a reasonable chance it'll be above £3.90 in 6 months' time. At least it's a chance we might be prepared to take a bet on. So, whether the variability is high or low is going to have an impact on how much we're prepared to pay for the option. So those are variables 3 and 4 in terms of how you value options. How long is it until the option becomes exercisable, and how variable is the price of the underlying asset? How much has it moved? And we'll calculate that using standard deviation. And then there is one final variable. We have an option to buy at £3.90, but as you will be very well aware from your previous studies, £3.90 in 6 months' time is not the same as £3.90 now. Yeah, £3.90 in 6 months' time is actually worth a little bit less than £3.90 now. So if we're going to buy a share for £3.90 in 6 months' time, that's actually a bit cheaper than buying a share for £3.90 now. How are we going to quantify that? Well, we're going to use a discount rate. We're going to discount that £3.90 back to the present using the risk-free rate. So that's the fifth variable that is going to affect the option price. If you want to see an illustration of how options pricing works in practice, then I suggest you Google the term Black-Scholes calculator, because there are a number of calculators available on the web that require you to input those 5 variables and will then spit out a price for you. And by moving those variables a little bit, you can see how they affect price. So if we go back to our notes, you can see those 5 variables set out for you. Now, just to emphasize again, you don't need to understand the model in detail, but the examiners do require that you have an awareness of those variables. The final type of derivative that is examinable, we're just going to mention now, because it's easier to illustrate when we deal with interest rate risk. And that is a swap. And we'll just be aware what a swap is an agreement to exchange one set of cash flows for another at a future specified time. So we'll look at those in the next chapter. Now, just to round off this section on introducing derivatives, it's very important to be aware that there are three completely different ways in which derivatives may be used. The most common way in which you will see derivatives used in this exam is for hedging. And remember what hedging is. It involves reducing or eliminating financial risk by passing it to someone else. So a hedger is risk averse. A hedger is aiming to reduce risk by use of derivatives. And in the next few chapters, we'll look at, in practice, how organizations can do that, how they can use derivatives to reduce very specific risks. But the second way in which derivatives can be used is for speculation. In other words, you can use derivatives to take a punt, to take a bet on whether the price of something is going to go up or down. Derivatives are very powerful and very effective tools for speculation. The speculator is a risk taker. The speculator is actually actively looking to increase their risk. For example, hedge funds make their money by taking risks and very frequently use derivatives to do so. It's worth mentioning that it is the speculators who create a liquid market. They are willing to buy and sell these instruments at a given price and therefore ensure that there is always a market for them. And then the final way in which you can use derivatives is something called arbitrage. And an arbitrager is someone who buys and sells the same thing at a different price. Let's say, for example, that you have a certain asset which in London is selling for 9p, and for various technical reasons in Singapore is selling for 10p. Now, because of time differences and the way the markets operate, this sort of thing does sometimes occur briefly. What the arbitrager is going to do is buy the asset in London, and then immediately, or as soon as they possibly can, they're going to sell it, the same asset, in Singapore. So they bought for 9p, they've sold for 10p, they have made 1p gain. What this is going to do, it's going to push up the price in London because you're buying, and it's going to push down the price in Singapore because you're selling. So quite quickly, these differences tend to be eliminated. You've got to be quick if you want to make this 1p gain. The differences also don't tend to be very large, so it's not possible to make huge amounts of money using arbitrage. But for some investment banks and similar organizations, if you can do this quickly enough, often enough, and with enough capital, you can make a bit of a revenue stream. And the good thing about this is risk neutral. You are not actually taking any risk here. You're buying and selling the same thing. Now the next section deals with disclosure and some of the accounting issues around derivatives and the issues they create for organizations. Now I should say at the outset that some of the accounting for derivatives can get quite complex, but for the purposes of this paper you don't need to get into the complexities, you just need to understand the basics and some of the implications of them. So financial risk disclosure covers financial instruments, and there are various categories of financial instruments. For our purposes, the most important of which are derivatives. There are three accounting standards that cover this area, and you just need to be aware at a very high level of what they are. We have IAS 32, 39, and IFRS 7. The most important thing to know are the rules, and that the fundamental rules that these accounting standards lay down are that all financial assets and liabilities must be recognized at something called fair market value. And if fair market value changes, then you must recognize those changes in the income statement. So if fair market value goes up, you make a profit. If fair market value goes down, you make a loss. And you must recognize that in the period. So you must recognize that immediately. Even if you're not planning to sell that financial instrument, even if you're holding it for years, if the value changes, you've got to recognize that change through your income statement. Well, what is fair market value? Well, if you have a derivative that is tradable, then fair market value is very easy. It's the market price. You can go to the market anytime you want and look up what this instrument is trading for. So that's dead easy. If, on the other hand, it is OTC or over-the-counter, it's a lot more difficult because there is no market price. There is no market you can go to and see exactly what it's trading at. In that case, quite often, organizations end up doing something called mark-to-model. They develop some sort of financial model that will generate a price for that derivative. Now, there are some risks attached to this, as we'll see. You also need to be aware the accounting standards lay down some rules about disclosure, and companies must disclose their key exposures and how they manage them. They must also disclose quantitative data, so numerical data about their financial risks, to allow investors to make a judgment about what their risks are and how well they're being managed. Now, in previous exam papers, we have seen this as the context for questions on what are the risks and what are the controls. So, thinking about what we've just talked about, the fact that all instruments must be recognized at fair value, whatever the market price is, and that changes in those fair values must go through the income statement. Have a think about how that can be a source of risk for an organization that uses derivatives, an organization that has derivatives on their book. What risks does that raise? And then secondly, how can you control those risks? See if you can come up with some suggestions for what you can do about them. Have a think about that and press play when you're ready to continue. So what risks are raised by having to value your instruments at fair value and take changes through the income statement? Well, perhaps most obviously, there is a risk to having volatile profits. If you are having to constantly revalue your instruments based on whatever's happening outside, you're having to take those changes through your income statements, your profits will be more volatile. Why is that a risk? Well, what happens if you have volatile profits? Shareholders don't particularly like it. So your share price is very likely to fall. Shareholders will not want to see volatile profits. They'll probably sell your shares. Your share price goes down. Who else isn't going to be happy about having volatile profits? Well, lenders might get a bit worried, and therefore they might charge higher interest. In other words, what's going to happen when you have volatile profits? Your cost of capital will rise. So there's a very real risk that your cost of capital goes up because of having to adopt these accounting rules. Are there any controls that you can put in place to try and manage that risk? Well, perhaps the most important thing you can do is communicate with investors and lenders. By the nature of your business, your profits are going to be volatile if you're dealing in derivatives. So you need to explain that to investors and lenders. You need to explain what you're doing, and you also need to reassure them that you are managing your risks effectively. What else might you do? Well, you might introduce trading limits. You might introduce limits to the amount of risk that any trader is allowed to take, and that will at least put a cap on the amount of volatility you're going to see. What other risks are there? Well, perhaps there is a risk of incorrect valuation, particularly with some of the more complex derivatives, particularly, as we mentioned previously, for over-the-counter derivatives, which are very, very hard to value, and there is a risk that you get it wrong. Now, if you get your valuation wrong, you then have to go back to the market and say, sorry guys, we got this wrong, then clearly there is going to be reputational damage. And this has been very true of many financial institutions in recent years. I mean, to go to your shareholders and say, sorry guys, we just lost another few $100 million, doesn't tend to go down very well. So what can you do to manage this risk? What controls can you put in place? Well, one control is to consult with experts. See if you can get an outside expert view on what value you should be putting on your derivatives. That way you're at least a little bit more likely to get accuracy. You're also going to want a procedure of constant monitoring. You're not going to want to be taken by surprise by sudden changes. You're going to constantly want to check and recheck your valuation. And one other procedure or mindset that would help here is to use conservative estimates. So when you're in doubt, value your derivatives lower rather than higher. That way, if you do get it wrong, it's more likely that you got it too low, and everyone's going to be absolutely fine with it if you can go back to your shareholders and say, actually, we've made more money than we thought. A third risk that may result from these rules is systems risk. For a large organization that is trading in lots and lots of different types of derivatives, they have to track the value of each of those derivatives all the time. Can you imagine how complex the system issues are going to be? So the complexity here is going to lead to a risk of misstatement because your systems simply can't cope. So what controls can you put in place? What can you do about that? Well, there is one input control, which is to make sure that you have enough investment in quality systems that will be able to do this. And a second control you could put in place, a procedural control, is to have regular testing and probably regular audit as well of those systems. So you're going to want to get your internal audit function involved in checking that the systems are fit for purpose and that they are doing a good job. There are probably one or two others as well. This is a very topical area, so do make sure you're able to think through issues like this. This is a big chapter, but it does lay the foundations of understanding of financial risk before we go on to consider some of the specifics. So let's have a look at what we covered. Well, we talked about what financial risk is in relation to this paper, risks relating to financing and international activity. We then looked at various ways in which it can be assessed and quantified, and remember the most important technique we looked at from an exam point of view is value at risk. You need to understand how to calculate value at risk and also how it may be used. Value at risk is very useful because it allows you to actually put a number on the risks you are running, which can help you decide how to manage it. We then looked at various controls over financial risk. Please remember that, like any other risk, you can think about input controls, in other words, have a Treasury function. You can think about procedures, such as having exposure limits in place. And you can think about measures, such as the one we've just covered, value at risk. So managing financial risk, fundamentally, is like managing any other type of risk. Now, one of the tools you may use to manage financial risk, or the collection of tools, is derivatives. And we looked at and introduced with some numerical examples 4 types of derivatives that are covered in the syllabus. Forward contracts, agreements to deal, to buy or sell something at a fixed point in the future. Futures, which are very similar except they're tradable. We touched on swaps, agreement to swap cash flows, and options, which gives you the right but not the obligation to buy or sell something at a fixed point in the future and a fixed price. And then we looked at the basic rules around financial risk disclosure, what organizations are required to report in their financial statements, and some of the risks that raises.